start. Great, thank you. And also just...
You're live.
Okay. Hi, everyone, and welcome to Emergence Headstart. Very excited to be hosting or to be introducing this session today. So, as part of doing the Emergence conference, one of the big things that we're all about is that the focus for the conference is the great transformation. And whilst 2022 has obviously been a challenging year, really it's set up, there's some big exciting technological aspects that are really coming to the forefront for 2023, as well as industry trends as well. And what's exciting is if you look at the lineup of people who are speaking today, whether it be from Peter, whether it be from Matthew, whether it be James Graham on the life science front, there's so many different exciting things happening across different sectors, whether it be edutech, whether it be fintech, whether it be just technology in general is playing such a role, whether it be from connectivity and also the acceleration of development. So for me, as part of this intro talk, I basically just want to cover just some of the simple things that we're seeing. And, I did mention this when I actually did my meetup recently, but I just want to cover 5 slides as far as what I think is super exciting about 2023, because if you think about our journey, 2020 was for many companies figuring out how to survive and then thrive during sort of COVID. 2021 was everyone was getting instructions, okay, you got to grow, you got to scale as fast as possible. And there was this massive surge of everyone trying to hire, bring on teams and so forth. And then 2022 was, okay, now you have to scale back and look for efficiency and move towards profitability. And the really interesting thing is that scaling back, and then also some of the things that are happening from software and also AI perspective have really created pretty exciting opportunities. So my presentation, let me just bring up my slides. Effectively, the common thing that I always love to mention is that all markets move towards efficiency. Effectively, solutions which save time, save money, improve efficiency. And effectively, look at the companies that are presenting and the people that are presenting today. That is really in alignment with what they're actually going to be covering from a presentation standpoint. Now, the next part to that is, these are some of the headlines which have dominated our headspace over the last sort of few months. And I think it's quite interesting because you're seeing this disruption and this enablement happen at the exact same time. I love the saying of software ate the world and now AI is eating software, right? And then also this digital transformation powering productivity, how AI is quietly eating up the world. So this has become quite standard. The last one that I'll mention is that how, B2B companies now have an incredible opportunity to scale just as fast as what some of the B2C companies is because of the access to data. The headline in the top left, where I talk about Tesla letting white collar workers go, is also an interesting trend, which we're also seeing start to take place. So obviously, November 30th, OpenAI released ChatGPT, and effectively, that lit the world on fire when it comes to the potential for generative AI. And we should have an exciting announcement about this, by the way, coming up for Emergence shortly. But when you think about it, it changes so many different things on many different levels. And this is just, we're up to now 2 months into this. And if you think about what this could look like 2 years from now, it does change a lot. I know from my perspective, I actually got it to write a press release for Emergence. Now, what is interesting about this from a press release perspective is a year ago when I asked a team member to write a press release for Emergence, I had it come back to me in a week and a half later, and I spent hours and hours editing it, right? This come back to me within seconds, and I couldn't believe what it did. And I literally made some small edits to it. So shortly you'll see this press release go out, and it is literally written by AI. And in fact, a lot of even the email promotions that are going out, a lot of it's actually being created initially on ChatGPT and then edited, right? And I say that because this is how the potential for productivity amongst companies becomes so much more exciting. Likewise, the potential revenue per individual employee also becomes exciting going forward. The other part is, I mentioned to people, I jokingly said I got inspired to become an artist on the holidays. And yeah, that's actually not quite accurate. This image, I literally plugged in some text and said, created artist impressions of 2 jet skis going under the Harbour Bridge at sunset. And within seconds, this image was created by DALL-E 2, right? And then, of course, there's the, I always forget its name. There's another version of this software, which is also just as incredible and impressive in what it can actually produce. But what it means is that creative potential becomes so much more unlimited in what people can do. Now, I'm not going to show this one because it goes into a video, but effectively on this video, I literally, for me, someone who's absolutely useless at video editing, was able to create a video. I spent 20 minutes, and then in that, I was doing adding all sorts of slides to it and so forth. And I think using something like Descript, as someone who's so useless at creating videos like I am, was transformational for me, because I thought it just really helped me understand how how much more productive the individual can be. Right, sorry, I'll move on for that. Now, my other favorite one was, this area. I thought about what a great topic that we can actually cover is the future of AI, blockchain, and also robotics. Right now, when I click on this, what's really cool about, I'll stop sharing for a second. Right, what's really cool about this from a standpoint is, from a creative standpoint, I'll just bring this up, is if you look at, okay. So now I went onto this software, I thought this would be an interesting topic to do something on. Now, when I actually go through this from a slide perspective, you think this is an interesting agenda, right? So if I'm going to be introducing this as a topic, the dawn of AI, the promise of blockchain, the future of robotics, etc. And then you go through all these different topics, and it's actually not bad. Now, one thing I didn't mention, what is so cool about what I'm showing you right now is I literally created none of it. So what I did was I literally went to this software and I literally typed in the future of AI, blockchain, and robotics, and it created the rest. So what I find exciting about what's happening from a technology, from a software, from an AI perspective is, as I said, one of the hardest parts in the generative part or in the creation of content is literally sometimes just starting, right? So when you actually get a starting point from a communication, it makes it so much easier to actually complete the rest of it. So there's so many different transformations that are taking place from a software and from an AI perspective that this entire ecosystem has become lit up with possibility. And also the other part to what's happening is that if you think about all the companies that are presenting today, effectively the productivity potential of their teams is massively increasing because of the software and also the different AI or the different tools that they have exposure to with their businesses. So what's exciting for me about this next stage is that whilst 2022 was a challenging year, if you think about the rest of 2023 and beyond, it becomes such an exciting time for investors and the kinds of returns that they can create, because as I said, the tools, the software, and so forth that's becoming available to companies is massively expanding their potential. So on that note, I'm going to hand over to the next presentation. I said, I know you got some incredible topics that are going to be covered. I said, one of the ones you'll really enjoy is JD from a perspective of talking about how to scale sales, right, with sales leadership, which is something that's really not talked about too much amongst the ecosystem. Matthew Kyle talking about weConnect as far as for any investors. I know I see Peter Mobbs on here. I know he deals with companies that are scaling. Scaling is super hard from an administrative perspective. And so when I saw what Matthew and weConnect were doing, I thought that is how you scale efficiently. It's a much more straightforward system than a lot of the other companies that are presenting, said covering technology, covering life science. I said, we're very fortunate enough for some of the incredible companies and people that we get the opportunity to showcase and that you guys get the opportunity to learn from. So I hope you enjoy the Emergence Headstart. It's a great sort of prelim or a view into what Emergence is going to be like. So enjoy the session.
Thank you, Steve. Our next presenter, our first presenter, is one of our Emergence Board sponsors, who is JD, Sales Director of Sales Director Central.
I'll unmute myself. My Valentine's card may have been written in ChatGPT, but anyway, let's move on. So I thank you for the introduction, Steve and Esther. On behalf of the team, I'm really grateful to have the opportunity of presenting to you from Sales Director Central. We provide fractional sales leadership. So what is that? That is very experienced sales leaders coming into your business between 1 and 2 days a month, putting a framework in place to help scale and grow your business. I'm going to spend the next few minutes talking to you about some data we collected on a survey and looking at research and scale-up phases in businesses. So what is our purpose? Sales Director Central is to use the power of sales to unleash the power of those superpowers, of those crazy enough to believe they can change the world. And those crazy enough is the investors and, sorry, the founders and the investors that invest in those founders. And our no-fail promise of value is to provide predictable and sustainable results. We did a survey with Steve's team at Wholesale Investor, and what came back is similar to what we see in the marketplace, which is that 60% of companies actually have no specific sales plan. They have no ability to understand where they're at with the sales during the year, and they basically running as hard as they possibly can, trying to generate the best possible outcome. 60% also have no sales methodology, no structured way of looking at customer data. 50% leave their product, do demos in the first meeting, let their product do all the talking, and 75% have a proposal template. I'm going to suggest templates are killing your business. Templates are created for a whole bunch of really logical, great reasons of being an effective and efficient way of getting a document out the door. But for most, they create about poor behaviors of copying and pasting. They become ever more increasingly about us and less about the customer. So the two phases that I mentioned at the top. What is research phase? Research phase is a phase every founder goes through. They look at they find a gap in the market, they create a product, a service, or an offering to solve that, and they become very product-centric. Their mindset becomes, let me show you, I can prove it to you. And I want to do as many presentations as I can to prove to as many people as I can that they can buy it. In research phase, the focus becomes on what we're selling and how much, and their pipeline is full of organizations that know what and how much. Scale-up phase, we have a different slant on it. There's a race to proposal. If you can't get a proposal out, they can't buy. And so we try as hard as we can to get proposals done. And deals progress on gut instinct, on what Fred, Tom, and Mary told me about the deal. And that deal that was going to go ahead before Christmas is still in our pipeline because their guts were potentially wrong as well. So we help people get into what we call scale-up phase. And what is scale-up phase is the evolution of the business. We go from the research mantra of understanding the product to understand the problem. So one of the changes we have with customers is that we don't want to understand a $70,000 solution. We understand $1 million problem. If you've got $1 million problem, we want to start talking to you. Our focus becomes a lot deeper on understanding the customer. We only show prospects what they need, not all the funky stuff we've got. And in research phase, I mentioned we know what and how much. In scale-up phase, the focus is on the customer. Who's going to buy? Who are all the people who are going to buy? The 10 to 14 people in a corporate. When are they going to buy? What's their time frame? And most importantly, why? The critical event, the burning platform. So we spend more time understanding some of the gaps in this knowledge in our opportunities. We help write a business case if we can, or help understand how they're going to get the budget, and spend more time with them understanding what we call the last mile. And we help them analyze deals more effectively and qualify out of opportunities. If you're not going to buy, we want to get out super quick. So we help people go from research phase to scale-up phase. So how do we do that? We have well over 200 years worth of sales leadership experience, and we crafted what we call the 6 pillars of peak performing teams, PAMIS. If you think about in your business, finance, if you think about development, if you think about project management, all of those have a framework to make outcomes predictable and more scalable and repeatable. We have the same thing. We bring this into a business, as we said, between 1 and 2 days a month, all underpinned by value. So what do we do both for investors and founders? The first bit that we do is we do what we call a blueprint. We write a report for you about what's working, what isn't working in your business. We look at 46 elements of your sales function and we rate it out of 10. We go deeper than any other DD process that we've ever seen in the market. and we come back and give you elements that you need to do to improve. And if we improve these elements, we've had clients double, triple, and quadruple their revenue. And we've even had 4 clients get to exit in the last 2 years.
JD, please make your closing remarks. Great.
Sure. So if you would like to book a meeting, here's a QR code for that. I look forward to seeing you at Emergence. Please email me if you've got any questions, JD at Sales Director Central. Thank you for the opportunity. Cheers.
Thank you very much, JD. Our next presenter is another Emergence Gold sponsor, weConnect. And we have Matthew Carl, co-founder and COO of weConnect.
Thanks, Esther. Testing, 1, 2. Can you hear me?
Yes, we can.
Can you see the screen?
Yes.
Awesome. So yeah, I was given 5 minutes, so I'm going to make this as easy to understand, and I hope all of your grandparents can understand as well. So, who's weConnect? We're basically making international expansion easier than ever. So what's the problem? Well, it's complicated to expand your business. So if you're expanding out of Australia and you want to hire someone in the US, you want to set up a company in Singapore, you want to set up a company in the UK, Brazil, China, Japan, Korea, it's a complicated process, and there's a lot of non-core tasks and core tasks to manage. Companies spend too much time on non-core tasks for international expansion, which just distract from growing the business. And growing the business is where you make your money, you can get your exits, you have the fun. The non-core tasks are really not the fun, but you have to still do them. So what are core tasks of global expansion? Talent recruitment, marketing strategy and execution, product and operational development. Basically, you should be spending most, if not all, your time on these general tasks and of international expansion. The non-core tasks are onboarding that talent quickly and happily. So those are like HR functions, benefit underwritings, making sure that your talent is being taken care of so they can do the job that you hired them for. Managing foreign business compliance, making sure that you're doing things legally in other countries, you're doing things that won't have the tax offices in the US, the UK, Singapore, China, Japan, Brazil knocking on your door and saying, hey, you're doing something wrong. So, even though that does sound important, it's non-core task to growing your business. So we're saying, hey, maybe that's not what you should be focusing on. Maybe you should help get someone to help you with that. And then also, executive and investor financial KPI reporting. So what does this mean? Even if you have a company in Australia, from just the bookkeeping, taking a receipt, getting information into a system, then into a format where CEOs, co-founders, founders can make decisions to drive the business in the direction it needs to go, as well as getting similar reports to people that put their hard-earned capital to help you grow the business, getting reports to the investors to help sure that they know where the business is going. And, and especially in the last 15 years, there was a lot of momentum investing. Maybe there's a shift to fundamental investing. People, I think, are really excited to make sure that they do get these reports. However, while these are important, again, focusing on the core task is really how you make a business successful. So what we feel like an optimized expansion, it looks like this. Companies should focus on talent recruitment, marketing strategy and execution, product and operational development. And we think you should engage someone like us or us for non-core tasks, onboarding talent quickly and happily, in Australia and other countries throughout the world. We think you should engage someone like us or us for managing foreign business compliance. And then also executive and investor financial KPI reporting. A lot of times when companies are starting to expand, understanding the financials quickly is important for, an important data point to know where your business should be directed, should be going. We can have essentially the whole world, the financials closed, reported to executives, make decisions, reported to investors in one business day. Typically, traditionally, if you're working with different people around the world to get this done, could take a month, could take 2 months to get that done. So we're doing that in a day. And then so our services really are to, hire talent in other countries where you don't have your own entity registered. So a PTY Ltd equivalent is not there. So we can hire them for you. We can set up entities, do everything needed to get those entities set up quickly, nominee director, address kind of services, visa application services, business license services, compliance for your companies, financial KPI reporting, I've already mentioned it, but doing the bookkeeping in Australia and other countries, getting that reported globally in one format, one policy in Australian dollars or whatever dollars you'd like to see it in. Onboarding talents, whether you have no entity or your own entity, we can make sure that's all done very, very good. And then also we can help with global tax optimization, global operating model optimization, recruitment, office space, and legal advisory with our partners. That's not with our internal team. We do this in 86 countries. We have the same solution, same experience in all these countries, and that's one of the differentiators for us. And so why are we different? We promise our clients they never have to repeat themselves. So you go set up in the UK, US, Singapore, and then you want to go to another country. Everything you've learned from that previous country, we can apply to the next country as it makes sense. So you don't have to ever repeat yourself. Then, we give you one point of contact to manage all your financials and administration for the world. We use one platform for communication. So if you want to use Slack, MS Teams, whatever, we can make sure we're meeting you where you're at, so you can have a comfortable experience communicating with our team.
Matthew, please make your closing remarks.
Yeah, we'll use one system like Xero, NetSuite, SAP, Oracle for the world, one process for the whole world as well, and one experience. Really, the one experience is where we save you a ton of time. And these are our happy clients. So, hopefully you can think of us if you want to expand your business outside of Australia.
Thank you very much, Matthew. Our next presenter is Bob Fu, Chief Executive Officer of IMAGION BIOSYSTEMS.
Great. Thanks for the opportunity to present here today. One of the key problems we have, back up. IMAGION BIOSYSTEMS is focused on improving the way we detect cancer and other diseases. Our proprietary MagSense technology is a non-invasive and does not use radioactivity and provides for a more specific and sensitive detection of cancer than current conventional imaging.
Would you like to turn on your camera, please?
Oh, sorry, thought it was on.
No problem.
Sorry, I need to stop sharing briefly. There we go. Thank you.
Perfect.
That's right. We have a pipeline of products for various cancers in development, and we've recently reported results from our study in breast cancer. So I'll go through that in a little bit more. But first, trying to give you a sense of why there's an unmet medical need here. So today we know that there's multiple ways to image the body. But one of the problems is that these imaging technologies are good at identifying anatomical problems, such as broken bones, blocked arteries, or even abnormal growths. But they can't tell you if the growth is truly cancer or not. So today, imaging is used largely to identify a suspicious lesion, which then needs to be confirmed by a biopsy. We're probably all familiar with a mammogram identifying a spot, but can't tell you if it's cancer or a more benign form of a tumor. So IMAGION is looking to change all of that. Instead of only identifying something as suspicious, our technology is aimed at being able to actually detect the cancer cells by tagging the cancer with magnetic particles that are then detectable by conventional MRI. So how do we do that? The tiny particles are coated with a targeting molecule, such as an antibody or peptide, that's highly specific for the If a tumor is present in the patient, the particles will accumulate at the tumor.
Bob, are you there? Are you there?
Yes, sorry, I got cut off. So I'm not sure where I got cut off. Did I get cut off here?
Cool.
You got cut off at the nanoparticles there, mate.
Yeah, thank you. So how it works then is these particles are coated with a targeting molecule, such as an antibody or peptide, that's highly specific for the cancer. And so when they're injected into the patient, these particles then circulate and try to find and bind to the particular tumor they're targeted for. If a tumor happens to be present, the particles will accumulate at the tumor and be detectable by an MRI scan. But if there's no cancer, the particles will harmlessly circulate and then be metabolized by the liver. So these are very biologically safe, and we don't use radioactivity. This approach of using a molecular targeted imaging agent for enhancing conventional MRI can be applied to many types of cancer. And this list here represents what our product pipeline looks like. In fact, in September, we reported some of our preclinical evidence on prostate cancer, and that announcement is available on our investor hub on our website. But more importantly, our lead product is already in a phase 1 study. This imaging agent is being tested for the detection of HER2 breast cancer in the lymph nodes. And this is an important clinical problem because once a patient has been diagnosed with breast cancer, the next thing you want to know is it's spread to or metastasized into the lymph nodes. And unfortunately today, confirmation of nodal disease requires a biopsy of the lymph nodes. So we think that a non-invasive way to detect nodal metastases would significantly aid in patient management. In December, we were very pleased to report that our imaging agent was not only meeting the objectives of the safety and tolerability in the study, but also detectability. And since then, we've had that confirmed by a group of independent radiologists. Just a week ago, we put an announcement out on that. So what does this mean? It means we have a chance to change the way we use imaging to detect cancer. Instead of using imaging to only look at morphological characteristics such as the size or shape, the imaging agent can actually change contrasts if tumor cells are present. On this slide, you can see the difference of the darkening of a node pre-dose versus post-dose. And that means that for a radiologist, it provides additional context besides just size and shape. They can actually see that there are particles binding to tumor cells, right? So this could improve the way patients are treated and ultimately save significant costs and avoid unnecessary biopsies. For each type of cancer, we have a specific injectable imaging agent, which would be sold to hospitals and would be eligible for reimbursement. And so we expect to attract strategic partners to try to help us commercialize these various products. So our revenue stream will come from partnering fees, but also a share in the revenue of the imaging agent. We've got a relatively simple plan for how to bring this to the market, starting with our first product in HER2 breast cancer and then expanding the pipeline. So we've got a good business strategy related to how we're going to go about getting to the revenue phase. With time being of the essence here, I won't go into too much on our financials. Additional information will be available later this month as we're reporting our annual report later this month. We've got a fairly wide shareholder base, but primarily retail oriented. And so in summary for this meeting, I'd like to just say that, we feel that we're addressing an important unmet medical need with broad applicability, and therefore we're addressing very large markets. And we have a clear business strategy. And our recently reported clinical results really puts IBX in a position where we think we're at an inflection point to start delivering shareholder value. Thanks for your time today.
Thank you very much, Bob. Our next presenter is James Graham, Chief Executive Officer of Recce Pharmaceuticals Ltd.
Hello, good to be with you. Just bring this presentation up. I'm James Graham, CEO and Managing Director of Recce Pharmaceuticals Ltd. Recce Pharmaceuticals is focused at the global crisis of infectious diseases, fundamentally the hypermutation that is antibiotic resistance or superbugs, and the ever-evolving viral pathogens. On an antibiotic side of things, we're in fact the most advanced class of antibiotics in the world at this time. And when we look to our lead drug candidate, sepsis, we're the most advanced sepsis drug candidate globally. Ticking across the page. Okay. So, whoopsie-days. What is Recce? I'll see if I can. All right, we'll go for this one. So what do we have? This is essentially, as a new class of antibiotic, a technology that's applicable to major unmet medical needs. Our largest, or in fact the largest in pharmaceuticals, is sepsis, double the second most, and results in around 30 million infections every year, of which 10 million are deadly. We've just completed a phase 1 study, as we see here, which has demonstrated our compound to be safe and well tolerated at levels well in advance of where our compound has been efficacious across small and large species animal groups, as is consistent with pharmaceutical development. In parallel to that, we utilize that same technology as a spray-on solution for burn wound infections as a broad spectrum nature of antibiotic. So gram-positive, gram-negative in their hypercellular mutated forms, superbugs. And we're just stepping into a diabetic ulcer study. In fact, I've just been out at Liverpool Hospital here in New South Wales to tackle the major biofilm challenges that represent a significant unmet medical need across a large patient population. And we'd expect data to flow from that within the first half of this year. As part of our portfolio approach, we have a suite of advanced preclinical compounds. The two mentioned here just by example, MPSS, which is the bacterial species associated with cystic fibrosis. We've demonstrated a BLOQ, or below limit of quantification capability, in animal species, and again demonstrated that in sinusitis. So different methods of administration for major market needs. This is a snapshot of our recent phase 1 study. Most pertinently, we achieved our primary endpoints. On the left-hand side of screen there, we see a nice dose-dependent consistency as we move from what was our starting dose of 50 milligrams through to our finishing dose of 6,000 milligrams. We're able to identify that in a 1 hour period via IV infusion, we can get that concentration up. And that's obviously the ideal objective of getting access to those deadly pathogens which exist in the blood. A unique insight we found in that area is where does that compound go? Well, it actually passes through the kidney and is excreted through the urine. And we get around a 20-fold increase residing in the human bladder. Well, there's no such thing as good bacteria in the human bladder, and UTI infections represent about 30% of sepsis infections, the flow down effect, of course, of a deadly bacterial infection in the urinary tract. So this lends itself to potentially be a urosepsis drug, a drug from early stage presentation through to the advanced stage of all-out sepsis. If I'm able to flick to the next slide. Okay, so fundamentally supporting this new technology is 2 layers. One, our suite or family of granted patents around the world. Composition of matter, methods of administration, methods of cure, preventative claims, antiviral claims, and so forth, out to at least November of 2037. Uniquely, we also have a government-backed qualified infectious disease designation for sepsis, giving a government-backed 10 years of market exclusivity, starting only from time of potential approval. Patents can fall over or be challenged. No one's going to take on that market exclusivity, and we're pleased to have that. As a snapshot, we're trading on the Australian Stock Exchange under code RCE with a market capitalisation of around $110 million, cash position of about $8 million, which we expect to continue to top up with R&D rebates in the near term. And we're getting ahead delivering on our infectious disease programs. We look forward to seeing you at the Emergence Showcase.
Thank you very much, James. Our next presenter is Gordon Edwards, Managing Director of Health Food Symmetry.
I'm still got my video as being stopped there. Okay. So can I start? There we are. We're good. Hi everybody. Thank you very much. So
will you be sharing a screen?
Can you see me now?
We can see you. We haven't seen you.
I will be sharing my screen. Just hang on a second there, please.
Great.
Okay. So our company, can you see the screen now?
Yes. Why don't you make it a presenter view? Yep. Full presentation.
Okay. So
Perfect.
Unlike most of the other presenters, let's just take it as a given that our product is on the market. Let's take it as a given that it's being sold. And let's take it as a given that we have protection for the product and also protection for our research. However, we prepared a SWOT late last year, and what came out of that SWOT is that we are very good at manufacturing, and we're very good at protecting our research, and we're very good at our research. What we're not good at is marketing. We're very bad at marketing. So consequently, we have taken it upon ourselves to engage with some of our biggest players over the last 2 or 3 months. And we have brought on a team of players such as Tismore, owned by Barry Smorgan, such as Marissa Peer, which is one of the largest psychologists in the world with 13,000 active practitioners. And we have also engaged with our phytoequine product for horses with the largest of the trainers in Australia, who are doing a 200 horse trial with our product. The last 3 slides are just proving that we understand our product, we have our product, and we have also made sure that we have a wide range of claims that are registered. We've gone in at the food with health claims as it was easier than TGA initially, and it started bringing in cash earlier. But with Tismore and other companies that we're working with, we will be going to TGA at a later date. So wholesale distribution. So we've got a supply agreement with Tismore Health and Wellness, which is owned by John Tisdale and Barry Smorgan. We've got a collaborative agreement for white label products globally. And we've also started shipping to them as of last year, second container going to them this year. And our product is essentially purely aimed at gut health, both in animals and humans. It's a standalone product. Nobody else has it. It's made from sugarcane. And the latest logistics for psyllium and other products that are like it show that we are now a less expensive product, and we can guarantee both supply and pricing going forward. We have a brand builder agreement now with Tismore, which, as I said, we're not good at marketing, but Tismore is. They sell into GSK, Procter & Gamble, etc. So the brand builder agreement allows us to give them our brand, and they will run it either as a white label product for Tismore or as a brand builder for Sunrise Health and Wellness, which is owned by Barry Smorgan, John Tisdale, and Kevin Williams. And this takes all of the cost out of trying to establish our brand. It takes all of the work out of trying to establish our brand and allows us to just do what we do very, very well, which is product formulations, manufacturing, and research. Marissa Peer has, as I said, has 13,000 of her own practitioners with 765,000 subscribers. We launched into her last week at just under 10% for the week of her subscribers. We pulled $1,500 for about 2,300 Australian dollars at 10%, which is about where we assumed our assumptions would be going forward. And once we launch into her practitioners, they will be launched as affiliations for our brand and for her going forward. We have distributors in Australia as well, and we're in 450 stores. And we're recommended by Monash Uni, UTAS, dietitians. We have about 4,500 dietitians that are on board as subscribers. And these are the current products we have. And what we're doing is we're just making sure that we have products that nobody else has. We're working with big companies to make sure that we're using their networks and not our own. And that's allowed us to cut $500,000 out of our current cash burn going forward, as well as just playing to our strengths while using the bigger companies that we're working with now to play to their strengths. We're seeking $1.5 million at 40 cents a share. Current pre-money valuation is 13,000, of which about just under 13 million pre-valuation, of which about 8 million of that is the factory cost, and the rest is research and the current assumptions we have for our sales going forward. And that's essentially what we are. We're protected, we're endorsed, we're disrupted to the current category. We've got a good management, a group of people there that really know what we're doing. We have zero debt, and we've now got national and international market reach. And I think that's about my 5 minutes.
Yes, on the dot. Thank you very much, Gordon.
You're welcome.
Thank you. Our next presenter is Colby Phyllis, Investor Relations Manager of Arcana Capital City Office Unit Trust.
Thanks, Esther. G'day, everyone. Let me just share my screen. Alrighty, so like Esther said, so I'm the Investor Relations Manager of Arcana Capital. Now, we're based in Brisbane, Queensland, Australia. And as you can see on the tagline there, we're commercial property partners tailored high-yielding portfolios. Now, what we mean by that is that we go out and buy commercial property and we place it typically in closed single asset unit trusts. Sometimes we do multi-asset unit trusts like a current opportunity now, but quite often they are single asset. And the reason that we do that is because it's a tailored product and a lot of our investors like to know exactly what they're investing in. So rather than doing a pooled open-ended fund where we can sort of tip in properties and divest of properties at our leisure, we like to get our investors as involved as possible so that they know exactly what they're investing into. We've got over 20 trusts of varied asset classes. So they include industrial buildings, like you can see in the slide here, large format retail, office, medical, etc. The current distributions that we pay to our investors range from 6 to 15% per annum, and that's just dependent on certain modelling and buying opportunities. To date, we've acquired over $187 million worth of property. The current opportunity that we're working on will get that over the $200 million mark. And we currently manage $94.23 million of current investor equity. The weighted average distribution, so if you were to have put in $100,000 across each trust with each property, then you'd be receiving an average distribution of 8.46% per annum. At which point we're paying out just under $8 million a year in distributions to our investors. Now, here's the process. It's a bit of an involved slide, but effectively what I want to draw your attention to is this risk curve and your commitment as an investor. So what we do, we analyse the market, we collect data on property and investor sentiments, we assess opportunities, we acquire them, we look after all the due diligence, all the capital raising, the finance, etc. And then we package it up in a unit trust, we settle, and then whoever invests and becomes a unit holder in that trust receive monthly distributions. We manage the property and add value where we can, and then we provide recommendations on divestment. Now, the important thing here is that we don't just roll over properties based on a timeline. We do have a typical 5-year hold period, but it's ultimately up to unit holders as to whether or not they want to sell the property at any given time via a vote. So if it's a bad time to sell, we'll recommend accordingly, and then it's up to unit holders via an extraordinary general meeting. Our team is led by Campbell Newman. Some of you might recognise him if you're Australia-based. So he's the former Premier of Queensland. And prior to that, he had a long career in infrastructure development and delivery. Peter Eccleston is our Director of Investor Relations, and he has a long career in the marketing of resources, mainly in the Asian markets. Christina Condon, our CFO, if you can see her there, she's got over 20 years of experience as CFO for 2 other large property funds, one based in Brisbane and one based in Canada. So she has a real handle on the numbers and how to get the most value out of our property acquisitions for investors. The current opportunity that we have going on, now I suppose I'll provide some context in that we do about 4 to 6 of these per year, and they typically run over about a 3-month period before they're settled and ready to go. So the current one that we're working on is the Capital City Office Unit Trust. Now this is multi-asset. We've got a large office building in 8 Mile Plains, Queensland, a suburb of Brisbane. And then we've got a large office building just outside the CBD of Perth. Now that's intentionally so because we wanted to get out of the competitive CBD market and more into alternative office assets. Now, this one is forecast to pay 7.25% distribution per year. Those are monthly payments. It's 100% occupied. The lease expiry average is across 4.2 years. We've got diversity in geography across Queensland and Perth, and we've got over 15 tenants. Now, most of them are either government-backed or multinational companies. We've raised 14 million so far, and we're requesting participation for 1.6 million, and those will be $1 units in the trust. So this one is an absolute cracker. It's the biggest one that we've ever done. If it's of interest, then you can find a lot more information on our website here, arcanacapital.com. Thanks for your time, everyone. Have a great day.
Thank you very much, Colby. Our next presenter is Delwyn Seller, Chief Executive Officer of MPSS. Oops, sorry, that was the timer. Delwyn, are you there?
Hopefully you can hear me.
Yes, we can.
I'll get the video going.
Great.
And the share screen. Have you got that?
It's coming up.
It's coming up?
Yes.
Fantastic. Hi, Delwyn Seller.
Delwyn, can you make it presenter view, slide share, as in the slideshow?
Oh, sorry, just one sec.
You just trying to full screen it? Yeah, just hit the presentation button.
How's that, Esther?
It's still not loading. Waiting for it to load. Yes, perfect now.
Okay, thank you. So, Delwyn Seller, My Property Solutions in Sydney. I'm the founder and CEO assistant for the company. We're an existing business. We began our business way back in 2005. We recently upgraded in late 2019, which involved a full review of and restructure of where we operated from, our personnel, and some of our client base to give us a preparation to grow into the future. We're basically a company that collects rent from the Australian residential rental market. And I want to give you a few little facts about that. The first is over a third of Australians do rent, and that percentage has been steadily rising over the last 10 years. Every state of Australia has its own legislative complexity with regard to landlords and tenants, and that complexity continues to grow. The vast majority of rental supply is from private individuals who purchase investment properties and rent that back into the market. And looking into the future, Australia has a bit of a chronic undersupply of property, and we see that continuing and obviously raising rents as we go further on. To prepare our business for growth, we basically sat down and reinvented the traditional real estate model and widened it to cater for the different opportunities now available post-COVID to rent property. Now, they could be short-term rental opportunities as well as traditional leasing, and of course the opportunity for sometimes for owners to sell property to their tenants. The model just also needed to cater for that growing complexity that we're experiencing through all state governments, the advance of technology, and just as importantly, put us in a position to grow our business by strategic acquisition and the merger of other real estate rental companies looking to divest of their income streams. Key members in our team, all of our staff have extensive experience, decades of experience in the real estate and property management market. Our CEO has been with the business since its inception. Our head of sales, Manila Falvo, has been with us for that same period of time. And our lady who heads up our property management division, Sky, also more than 10 years of experience in the residential and rental market. So we're looking to work with investors to add scale to our business, not forgetting that we already have a fixed flow of income from our existing income stream that helps us cover our current costs. So investor capital will basically apply to help us acquire new income. We believe that we've solved one of the great challenges in the real estate industry related to growth and expansion, and we're able to provide our services from just the one location, which further compresses our costs. Obviously, the great benefit of scale is that as our income increases, our percentage of costs to that income will continue to decline. We're looking to work with investors by providing a regular rate of return of 7% per annum, paid monthly in arrears, and that's via redeemable preference share, which will allow investors to exit if they so choose at the end of a 2-year term. Just as importantly, we're also providing within that mix an opportunity for the investor to redeem that preference share to access a property and a luxury apartment at a fixed wholesale price that's based around today. Now, we're not talking about an ordinary development. We're talking about access to a property which will be oversized, a luxury unit with all inclusions in a building that will have city and perhaps harbour views, and will also have connection within it to 2 hotels, a neighbourhood supermarket, alfresco dining areas. So there's a real opportunity for lifestyle improvement for the investor, or alternatively, consistent income from that property into the future. So in short, our offer to investors is based on a consistent 7% return, the ability to withdraw their initial capital at the end of that 2-year period, or convert to that apartment and then cover or taking into account the growth that's taken place in capital gain over that period of time. We're also going to be presenting at Emergence, so we look forward to the opportunity to meet with you there, or alternatively, if you go through our deal room, I'd be more than happy to speak with you prior to the event. So that's it from us, Esther.
Thank you very much, Delwyn. Our next presenter is Peter Smith, founder of Hound Group. Peter? Great. The slide is showing.
I'm Robin. I'm just waiting for
Robin.
to...
Hello. Thank
Hi.
you. I hope you can now see me. I was a little surprised, Esther, because I thought there was somebody else before me, but I'm ready to go. So thank you, everyone. I'm Peter Smythe, and this is Hound. There's nothing else like it. My colleague Robin will be flicking the slides for me. Hound is a game changer for the mortgage broking industry here in Australia, and it's also a game changer for Australia's army of hard-pressed home loan borrowers. Why do I say that? Well, it's a game changer because it transforms the way brokers work with their customers, and because it puts borrowers back in control of their home loans. That's a big statement, but let me explain a bit more. Why do we say Hound is a game changer? Well, we say that because it's solving the industry's data problems. Data is the mortgage industry's Achilles heel. Data is fragmented, it's out of date, it's incomplete, and it's incorrect. And it's also structured around lending transactions. It's not structured around borrowers as people. So no one today has the full picture, not lenders, not aggregators, not brokers themselves. So everyone, therefore, just throws their hands up and focuses on acquiring new customers. It's only Hound, as you can see here, that's focused on solving the industry's data problems. So how do we do this? Well, we equip brokers for the first time with the tools that will allow them to be a trusted advisor to their customers. What does that mean? Well, we create and maintain an up-to-date database for the broker's customers. We identify which of their customers have unmet servicing needs. We then go on and do some of that servicing work on the broker's behalf, and we build a track record to support the sale of the broker's business when they're ready to exit. Now, amazing as it may sound, this isn't possible today. Remarkable, I know, but true. So what's the result? Well, quite simply, by using Hound, brokers retain customers they'd otherwise lose to competitors. Simple as that. By retaining their customers, their business grows, it's more profitable, and it's more valuable for when they want to sell out and exit the industry. So Hound pays for itself many times over. What's the alternative? Well, the alternative is the no growth trap, sometimes called the hamster wheel. And this is where existing customers are leaking out the back door while you're busy trying to bring new customers in the front door. Now, that's no way to run a business and no way to create any enterprise value. So where does Hound have the greatest traction? Well, we're focused on the segment that is the most productive, professional, tech-oriented component of the full-time broker population in Australia, which we estimate to be about 12,000. And that segment we're focused on includes those brokers with a long runway in the business. It includes those building a professional practice. It includes those who probably acquired portfolios as a way of growing. So it includes the professional growth-oriented brokers in the industry, and that's where the trend is heading. Our standard pricing is $1 per month per loan. So you can see that if we build up to 1 million borrowers on the platform, that's how we reach a revenue run rate of $12 million. So what's the evidence that Hound actually works? Well, the proof of concept has occurred over the course of the last year with us working with Yellow Brick Road's orphan loan customer book. This is a book of over 2,000 orphan loan customers. Therefore, it means they've been largely unserviced for many years. We loaded up the data, we identified the action required for these customers and fed them back to Yellow Brick Road. With that under our belt, we've now moved on to working with Yellow Brick Road's network of franchise brokers and indeed to over 1,000 of its independent brokers that use its VAO aggregator service. And we're also now working with other aggregators and lining up other special use cases to continue the expansion. So who's making all this happen? Well, mortgage broking is a sort of a traditional relationship-based industry, and it's now going through a period of significant change. But to be successful in this industry, it's about both what you know and who you know. It's essential to be an insider in this industry to build trust. And that's why Hound's team is sort of full of industry luminaries and data experts who've lived their lives in the mortgage industry. And as we say, they speak broker.
Please make your closing remarks, Peter.
What's the ask then? So our current Series B round, we've already raised 1.2 million. We're looking for another $500,000 to complete that round. This will be the last chance to get in before our final growth capital raise of ordinary shares. And therefore, that is Hound in 5 minutes. Thank you.
Thank you very much, Peter. And thank you to Robin as well. Our next presenter. Thank you. Our next presenter is Matthew Edmonds, Group CEO of Geniusto.
Yes, good afternoon, good morning, everybody, and thank you very much for the opportunity today. Give me a moment while I do my screen share and get the slides up. Please let me know if you can see my slides correctly.
It's coming up. Perfect.
Okay, excellent. So thank you, everybody. 5 minutes. It's a very short space of time, but we'll keep this really brief now. So accelerate your digital economy investments with Australia's fastest growing digital banking technology provider. So at this particular time, there are tremendous challenges for investors. As Steve had alluded earlier on in his introduction, in 2021, it was all about growth and investors were deploying a lot of capital and pushing for rapid growth. 2022, we saw some major pullbacks, and now people are a little bit more conservative, looking for, solid investment opportunities and lower risk, I would say. So macroeconomic headwinds, we all know about the issues with inflation, which is not going away anytime soon. Increased competition, so there are more and more VCs and PEs that are looking to put capital into opportunities. The returns that they're getting from the stock markets are dubious at best, and so risk capital is looking for a home. Regulatory uncertainty. There's a lot of changes around the world in terms of regulation, especially with the debacle with FTX. Governance was not there. The VCs lost an enormous amount of capital, and so now they're a little bit more risk averse. So they're looking for opportunities that are solid, that are dependable, and enough upside to make it interesting, but limiting the risk. So what are the key challenges for financial institutions? We address financial institutions as our customers. So what are they facing? So they're also facing tremendous headwinds. Compliance. We talked about regulation, and there is a tremendous amount of new regulation being kind of brought to the fore very quickly. So we help companies with compliance. We help them with agility. A lot of them are working with aging tech stacks that just can't address the rapid changes in what I call the digital economy market, right? Relevance, remaining relevant with what their customers are looking for. Customers need to have everything now in their mobile devices. They want speed. They want to be able to pay their bills and make investments and do all kinds of things directly from their handset. These are massive technological challenges for institutions. Institutions tend to be a little bit conservative and slow, and staying relevant with their customers is important because there are many fintechs that are coming in to challenge the traditional institutions. And of course, efficiency. When we talk about efficiency, it's not just efficiency of your operations, but ensuring that efficiency of their use of capital, and of course that all translates into margins at the end of the day. So Geniusto is addressing with a very powerful suite of tools all of these challenges for institutions. Now, I'm not going to spend a lot of time talking about the technology itself and what we do, because we've only got 5 minutes today, but just a quick overview. What we provide are really a suite of powerful tools with core digital banking, onboarding compliance, so eKYC and eKYB, and those who are in the banking space will understand exactly what that is, about understanding who their customers are and authenticating those customers, measuring risk, etc. Payment orchestration is really important with all of the anti-fraud and transaction monitoring tools that need to be brought to the table nowadays. And of course, the growth factor. This is a multi-entity, multi-tenant solution that allows them to not only have multiple licenses that they're offering, so different banks and institutions that they are owning and operating, but downstream they can offer their services to innovative fintechs through embedded finance, through our multi-tenant capability. So infinitely scalable product now. We talked earlier about what investors are looking for in terms of stability, growth, and management. We have a very experienced management team. We are not 20-something, fresh grads with a PowerPoint and a dream. We've all been, operating businesses for 30 plus years. We have a number of directors who do also sit in other listed entities. And we are a public company, which is important. So we're not yet listed, but we are in Australia a public company. So a great team behind all of this. But this is what we really wanted to show today. This one slide really tells the story. 2020, we raised $7.1 million Australian of seed capital. This went into establishing the initial sales infrastructure, setting up the entities, and then we acquired a very powerful software from Europe. The company was at that time called GCP. We rebranded everything. We actually finished the acquisition in February of 2021. So in a 10-month period, we did $2.4 million in revenue on our first year. But also in 2021, we went to the capital markets and we did a Series A raise. We raised 8.7 million Australian, which was then pumped into a number of areas, obviously market expansion, upgrading the technology itself, bringing new features, new bells and whistles, etc., etc. 2022 has been a fantastic year for us. We've expanded into new geographies. We signed 11 new customers. These are financial institutions around the world, including our first one in Australia. And that gave us $4.02 million in revenue. We're now into 2023 already. We'll do it. Perfect. So we're now looking at a pre-Series B raise of $10 million US. And given the pipeline that we have, And the fact that this is a picks and shovels play with recurring revenues, we're very, very confident of reaching an enterprise value of 100 million by the end of 2025. And we're looking at a 2026 listing. So solid experienced team, mature, stable, full-featured product, verifiable revenue growth, clear vision and business strategy, and happy customers who are referring new business to us. 40% of our new business last year came from customer referrals. So don't miss out on this unique growth opportunity. Contact us today and we'll be able to share the complete information memorandum. It's a very exciting investment opportunity. So looking forward to meeting you all in March in Sydney.
Thank you, Matthew. Our next presenter is Phil Williams, founder of Make Good Give Back.
Thank you, Esther. Can you hear me?
Yes, we can.
And can you see me?
Yes, perfect.
Great. I'm going to try now to share the screen I want you to see, which hopefully is this one.
It's coming up.
Have you got full screen there?
Not yet. It's still coming up. Great. Perfect now.
Fabulous. Thank you, Esther. Hello, everybody. Some tough acts to follow there. Apologies ahead of time for any nervousness I might show. Thanks for your time today. We'd like to share an opportunity with you, a very early opportunity, and that's to get a hold of your data and get savvy with it, get paid and give back. Quick disclaimer, first of all, this is not financial advice. So let me just see if I can get, okay, it's not financial advice. Please talk to us. We're sharing an opportunity at this stage. So what is that opportunity? We'd like to think it's your opportunity, it's everybody's opportunity, it's mine, it's yours. And what we're looking to do is to help you own and control your own personal data and use that to improve your financial well-being. And hopefully everybody else gets a crack at it as well. So that's to basically put data ownership and control back in the hands of people. Big ask, and what our platform is looking to do is help people get that data, and just like the strapline says, to basically make it work for you. But what we're also looking to do is to bring together in the process people and large organizations. I'll explain that a little bit more. And we think that we can generate some remarkable insights that produce some pretty substantial benefits to everybody involved. It's got to pay for itself. But I just want to emphasize to you also that we are very early on in our stage, and there's a lot of established businesses that I've just been listening to. So why are we doing this? What's the problem that we're looking to solve? It's about wasted data, wasted money, and wasted insights. So, of course, this is a one-way street for all of us. We're all very familiar with how big organizations, fantastic, no issue there, but they're making billions, and basically we're giving it all away. And we're left feeling like walking wallets. And the problem is that we just can't collaborate as people and as organizations. I'll explain what I mean by collaborating. Problem is, though, with that is that we as individuals, people, families, small business owners, we're missing out on some amazing insights into our health, wealth, and happiness. We don't have tools, we don't have incentives. And this is being picked up pretty much by a lot of frontline support groups and during a cost of living crisis, which I'd just like to elaborate on. You might be saying at this stage, so what? We think that the so what here is a big need for change, and that drives our purpose as a business. We want to help you get your data and put it to good use for you, first of all and foremost. There are three groups that are in this whole thing right now, and the impacts that drive our purpose are the things that basically are driving a big conflict that is putting these groups on a collision course. That's us right there in the top left, all of us on this call and lots of other people. And we know what we do in day out. We earn our living, we spend, we save, we invest. And that involves, through the course of regular commerce, massive transfers in data and dollars. Of course, we all know that, but we're leaking all that value away. There's a massive imbalance in the value of our data. There's a cost of living crisis, so people are losing money, basically. And that impact's felt across all demographic groups. It's not just the needy or the people on breadline, it's basically everybody. The frontline groups pick this up first of all, and they're seeing the impacts in financial and mental well-being. This is a big issue. But those groups are driving legislation and regulation, impacting businesses and government departments. I just want to flick to you that the cookies are disappearing these days, and third-party data on sale has got a bad name. So it's driving ever greater hunger for our data, and it's destroying trust, margins, and brands. So how are we tackling this? We've got one approach. It's a data-driven financial engagement platform. It's a scale platform that brings this collaboration together to try and resolve this conflict before it gets too bad for everybody. But it's a platform where you share the data and you share the value, and that works always round, people and organizations. It's for everyone, and we mean everyone, and it deals with the conflict by incentivizing collaboration. So how does it do it? Well, very quickly, it makes data ownership and collection easier for people. We're all too busy to be messing around with data. It's got to be easy. And it improves your well-being, but it's not just practical, it helps you with your longer-term strategic issues as well. It gives you cash for consented data. And it's a pay-as-you-go channel for big organizations, basically to get remarkable insights and save lots of money. This is a network effect, as most things are, and there are two parts to it. First part is purpose-driven for us. We work first for people. That's the bottom line. And as a result of that, what we're driven by is people's fascination with their lives in data. Engagement is flow, and we work hard on engagement, but we bring real benefits to people in the process. And what we're using that is to drive engagement at scale. And through that process, we want to help people with their financial and mental well-being. It's a big issue. What we also want to say is that this is a no BS platform. You can't talk about financial well-being, although most people do, unless you talk about cash. So you've got to have cash in the equation. Second part of that business model is incentivizing organizations. Why would they do this? You know, data is freely available to a lot of people. Well, quite honestly, there's a big cost if you don't, but what we're looking to do is help bring truly remarkable insights to people who give that consent. That's new.
Phil, please make your closing remarks.
So what I'll do is finish on that. There's a very big market. There's some evidence, lots of social proof. We're going out to build some credibility through partnerships with companies and big agencies. And we've got a pretty experienced team, and we've got some early traction. And we'd really love to talk to you about this a bit more. Thank you very much.
Thank you very much, Phil. Our next presenter is Michael McCurdy, Chief Revenue Officer of Kendo.
Hello?
Yes.
Hi.
Well, we can see you.
Sorry, bit of a delay on that.
No problem.
Okay, let me share the screen. Is that all working?
Please make it slideshow view. Great,
Yeah.
perfect.
Okay, thank you. So I'm Michael from Kendo. I'm the CEO and co-founder. We're looking to raise $800,000. We've raised $200,000 already, and we're an ESIC approved investment. So there's some significant tax advantages for anybody who looks to invest with us. We're essentially a B2B SaaS platform, and I'll go through and explain that to you now. The essential problem that we aim to solve is that of execution. And this guy, who's pretty good at it, summarized it as follows: there's ideas worth nothing unless they are executed. And execution is worth millions. And this is the problem that each business here is facing today. Every person that has spoken to you so far will be thinking through how they achieve what they plan to do. And so how do we do that at Kendo? If that's a problem, I think everyone would understand it rather well. The problem is, like, what do we do to make it work? So what do? We enable businesses to go through, in the first instance, take these ideas and turn them into significant plans. And these plans get rolled across the organization, and we define how execution will work and what success would look like. And then the platform does the next most important thing, the introduction of the scariest variable of all, the people. And so now we have to deal with the fact that we've got teams, people in different roles, different capacities, different backgrounds, diversity, work from home, all sorts of stuff. And what Kendo does is get these people and lines them up and connects them to the plan, and equally connects their personal motivations to the business. Now, of course, this is the problem. The people problem is the biggie, and this is where so many businesses can come undone. And I think the great saying along the lines of, you know, any plan is great, but its execution is really reliant on the people that do it. And so what we aim to do is to strive and develop the best performance improvement for the businesses and the people equally. How we do that is by separating out the idea of a person and an organization. We recognize that there are board members and executives who have a very different relationship to the business. There are individuals and teams, and then there's even HR who has a role and a function. And all of these people need to approach what they do on a daily or monthly basis in terms of planning and performance, and we align it and we engage those people. And that's essentially what we're about. Now, how we do this, our SaaS platform, which is very comprehensive, is founded in a couple of critical methodologies. Now, they are rooted in both management science and organizational psychology, industrial psychology, and social sciences. And those methodologies manifest in essentially 4 core solutions. The first is strategic alignment, which is about how we connect everybody to the plan. Performance improvements, how we, in an ongoing, real-time, agile and adaptive basis, keep working with the fact that the world does stuff and we have to change. And then at an individual level and at a team level, dealing with the people front, we start to talk about talent development and creating high-performing teams. Now, all those things combine to give us what we hope is our highest chance of success with executing the plan. As we do this, inevitably data is produced. And we create a data lake of very useful things, and we can start to intuitively develop and understand in terms of information useful for the board, in terms of governance, or the execs who might be looking at execution analytics, knowing what is the likelihood of us hitting our Q3 targets. From a personal level, we can start to look at employee experience, or HR might look at it in terms of people analytics and saying, what additional skills do I need to do in here? So that's our solution. And we've been very successful. We've got a bunch of businesses on board, but 3 that I'd like to call to attention. 2 ASX businesses. One is Essity, and the other is Magnetite Mines. Essity was a struggling business, 5 years of declining trends, and then they introduced Kendo, and in the space of not very long, they turned it around. And not only did they produce profit and growth, they also really uplifted the engagement of the people. Essity had from the exec suite to factory workers in Fiji using Kendo. Open Country is a big producer of exporter of milk. They've introduced Kendo as their core solution for how they manage HR and deal with an issue relating to staff churn and things like that. It's been very successful for them. And then Magnetite Mines is a $1 billion project that's just going to go boom. And what we're going to find is that there is 500 people that will be employed into that, and they've selected Kendo as their preferred solution. So we're very excited. There's a couple of things that we've done that are very key. The first is we've got 1,000 users on board. That validates the solution. The technology is validated, it's robust, it's in market, and that's all very healthy. We've done this with 0 salespeople, and we've launched a very exciting partner program, which I'm going to share with you about. And so our investment is really about the salespeople and partner program. So we've got this motto, grey is the new gold. There are a lot of talented, capable people in the latter end of their careers who are looking to do exciting work, and they have unparalleled access to boardrooms and decision makers in businesses. We've got a very extensive network spread across a number of countries and 20 offices, and that gives us an unfair advantage. We can get into rooms, we can have conversations that allow us to open up, but that is, comes at a very minimal marketing cost. The net effect of that is we do great implementations and we build lovely brand equity. So if I was to look at where the money's going to go and give you a bit of a financial forecast, based on the strong pipeline that we've got now and the growth in the network that we're building, the money is looking to grow us to break even by end of next financial year, and then to go rapidly past that in the year after. So that's us. We are looking for that $800,000 investment. We'd like to work with any of you here. Frankly, we are there for many businesses. Our particular interest is in growing with investors that are excited by B2B and SaaS products. Thank you.
Thank you, Michael. Our next presenter is Jackie Bloom, Growth and Investment Director of Startupbootcamp.
Thanks, Esther. I shall share my screen. Okay. Are we good to go?
We are.
Excellent. Okay. Fantastic. Good afternoon and thanks for joining. I'm Jackie Bloom and I'll be presenting Startup Bootcamp and the Sustainable Fintech Fund. So a little bit about who we are. We are the largest global industry-focused startup accelerator. Originated in Copenhagen in 2010 and since then has expanded globally across Europe, Asia and the Americas. Trevor Townsend is our CEO of Startup Bootcamp Australia. Started in 2017 in Australia and ran our first program in 2018. To date, we've invested in over 1,000 startups. We are particularly proud of that of those, 76% are actually still active. And given standard attrition rates, this is something we are really excited about. We work really hard to help teams become sustainable and scalable businesses. 72% have gone on to raise further funding and 41% are female-led. So really about a proven model to de-risk and accelerate startup investments. So what we do as an accelerator program is we get our startups pitch ready, commercially ready, and investment ready. And how do we find these startups? Well, great question, and I'm glad you asked it. We scout our startups globally through a scraping process. We scrape roughly between 20 to 30,000 startups around the world, and then we finally run a due diligence process to narrow down the field to the final 20. Once we get to that final 20, we invite our investors, our mentors and advisors as part of the program to our selection days, and they become part of the selection process. So you actually get to have an opportunity to choose the startups that come into the program as an investor. So why be part of the Startup Bootcamp? So why be part of the Startup Bootcamp Sustainable Fintech Fund? So recent data from CB Insights report, fantastic report just released, showed that whilst their growth declined in 2022, numbers are actually still double those of pre-pandemic figures. The industry is still hot in terms of investment into fintechs. The tail end of 2022 has seen funding ramp back up again. So we're really aiming to show that funding, particularly around ESG-focused fintechs, is growing rapidly. And in fact, if you put climate fintechs or an ESG-related fintech, that number grew by 88% from 2021 to 2022. So again, a really exciting time to invest into early-stage startups across fintech and sustainable fintech. Which brings me to why sustainable finance. Well, we really believe at Startup Bootcamp that it is the next big opportunity, bigger than blockchain, bigger than buy now, pay later. Sustainability globally is becoming more relevant with every year that passes. And some of the biggest decisions that we will make are really around where we can when it comes to money and sustainability is where our money is being banked, managed, and invested, really leading to a more sustainable future. So why sustainable finance as a theme for Startup Bootcamp and as a theme for our fund? Well, when we consider future trends for startups, it's clear that fintech alone will continue to be a growth sector. When we add the word sustainability around fintech to our research, the data revealed an 800% increase in the number of global startups focusing on a fintech with sustainability as an approach. So to unpack that a little bit further, we took sustainability and finance and we looked at the 17 UN Sustainable Development Goals. When we looked at that, we considered how they could either impact or be impacted by our current and future financial decisions. The result is that we uncovered 8 of those UN Sustainable Development Goals where the intersection of finance and sustainability meet. We group these into 3 key themes: financial well-being and inclusion, sustainable business practices and communities, and financing sustainable growth and resilience. So when we select the startups to join the program, they must meet at least 1, if not 2 of these key themes. Our team, core team raising the fund is myself, CEO Trevor Townsend, and Exec Program Director Richard Selm, both of whom are seasoned angel investors with startup experience and successful exits. The investment opportunity and the exciting part is most importantly the opportunity to invest into our Sustainable Fintech Fund. It's a $5 million fund that we're currently raising. We'll accelerate and invest into 30 early stage startups over the next 3 years. 1 program a year for each year over the next 3 years with 10 startups in each program. The investment terms are exceptionally favourable for both the investor and the startups, and we're targeting a 3.3 times multiple with a minimum check size of 25K subscription. Our current average subscription is 50K investment. I'm Jackie. I'm more than happy to continue this conversation. If you've got any questions or would like to join the fund or hear more about the fund, please reach out. Thank you.
Thank you, Jackie. Our next presenter is Peter Motz, Managing Partner of 5 Sigma.
Thanks, Esther. Let me know when I can share screen.
Sorry, am I still sharing? Oops.
That's okay.
You can share screen now, Peter.
Great, thank you. Can you see?
Yes.
Okay, so we're a growth fund. 5 Sigma is a growth fund investing exclusively in global edtech opportunities. Our mantra is that we back companies that create social and economic value. Before I get into what edtech is, I'll just explain very briefly why you should invest in edtech. So essentially, whoops, is that frozen? Can you still see it?
Yes.
So edtech is essentially all of the technologies that surround the $6 trillion education industry around the world. So edtech is short for education technology. It's the content, the hardware and the software around that $6 trillion education industry. So it's a great place to be investing because it happens to be one of the fastest growing segments of technology. So technology has had a great run, but if you look under the covers, they're not all equal. Ed tech is growing at around about 16.5% CAGR for the next 5 years, which makes it one of the top segments within technology. So to give you some examples of what an ed tech business looks like, the most used ed tech would be Duolingo that you might have used. I used it during the pandemic. It's an app that helps you learn different languages. It uses artificial intelligence to look at what you know and what you don't know and ask questions to help you in those areas that you haven't yet learnt or mastered. At the other end of the spectrum is a business called Go1 that's based here in Australia. It's an aggregator of digital corporate training. So they don't produce any of their own content themselves. They go around and cherry pick the best of the best, put it on the platform, and then license that platform to corporates. So that's essentially what EdTech is and some examples. But as to why investors should invest in EdTech, first, it's one of the largest industries in the world, or education rather, is one of the largest industries in the world. It makes up around about 6% of GDP globally. The problem with education is that it's a complete digital laggard. Only around about 4% of the education industry has been digitized. So it's ripe for disruption, and we're just at the beginning of that disruption curve. So as at 2020, around about $220 billion was spent on digitizing the industry, which is fantastic. Even better, that spend on technology is likely to double to over $400 billion by 2025. The problem is, once that happens, the whole industry is still only going to be 5% digitized. So we've got this huge, long runway of growth in the technologies around that $6 trillion education industry. So we see this as the ultimate time to be investing in. It's essentially the picks and the shovels of that $6 or $7 trillion education industry. So our focus is on growth investments. So we don't do early stage, we don't do startups. We're sort of sitting halfway between venture capital and private equity. So we're a genuine growth fund. Our sweet spot are Series C and D rounds. And we really like that growth area for a few reasons. First, it's much lower risk, and the path to liquidity is much faster. So it's a much safer area. We've been doing this for about 20 plus years, where I've personally had a couple of exits in the space. So we've got a bit of an edge to a generalist that allows us to deliver proprietary deal flow, but we can also see the risks and pick the winners to a better degree than a generalist fund can. That's a little bit about me, but we don't have time. We've got a really good quality team. We've got some phenomenal investments. Academia based in the US, that was a Series D. Co-investors are Tencent, True Ventures and Khosla Ventures. Our second investment is a business called Go1, based here in Australia. The co-investors there are Microsoft's M12, Salesforce Ventures, SoftBank, Madrona, circa 100 million in ARR. So these are really high quality global leaders. I'd love to talk to you more about it, where our fund is open now. We're taking on investors to tackle global ed tech opportunities. So you can reach me direct or via the Chris platform, and look forward to seeing you at the Emerge conference. Thanks, Esther.
Thank you, Peter. Our next presenter is Arjun Kaushik, founder of VitalTrace.
Hi there. I can't quite start my video. I think it's preventing me from starting. There we go. Perfect.
Great. Perfect.
Hi, how are you all? My name is Dr. Arjun Kaushik. I'm a medical doctor. I'm the Chief Executive Officer and co-founder of VitalTrace. Now, can you all see my screen that I'm sharing?
Yes, perfect.
Perfect. So we're working on the new global standard of care for childbirth monitoring. Now, in most areas of medicine, we've had reliable diagnostic tools for decades. You can think of the ECG or the chest X-ray. And despite childbirth being so central to mankind, obstetrics is one of the last remaining frontiers of medicine without one of these basic bedrock diagnostic devices that works. And so we have this enormous opportunity, with obstetrics being like 100 years behind the times, to really innovate in this space. Now, 90% of mothers who go through childbirth receive the standard of care fetal heart rate monitoring up on the screen, and this is inaccurate. Now, subjective interpretation can mean missing or delaying diagnosis of a baby in distress. And this can lead to permanent brain damage, which has enormous effects on the mother and the child, and a huge cost to the healthcare system. Now, furthermore, there's a 70% false positive rate, meaning that hundreds of thousands of mothers undergo unnecessary C-sections per year for babies that were healthy the whole time, which costs, each of them costs $6,500 more than a vaginal delivery. So the healthcare burden each year in just the US and Australia alone from these two issues is more than $5 billion every year. So clearly measuring heart rate is the wrong metric. Well, what is the right metric? Well, we know it's something called fetal lactate or lactic acid. And very simply, it goes up when oxygen goes down. And there are already widespread accepted clinical guidelines directing clinical action when doctors can get a sample. Now, the problem is getting a single blood sample from a baby in utero. As you can imagine, it's time consuming, it's difficult, it's impractical. So that limits its use and its utility. So the critical unmet need is doctors need a way to access this objective biomarker lactate without the difficulty of having to do a blood sample. And ideally it's continuous so that evidence-based decisions can be made in real time over the course of labor. And that is exactly what we are offering. So we're developing a continuous lactate monitor that obstetricians, midwives, and even the FDA believe is going to be a breakthrough that we've been waiting for decades. We've created this single-use, cutting-edge biosensor that goes onto the baby's head, and it delivers lactate and fetal heart rate in real time for the very first time in history. Now, it connects via a wire to an electronic wearable leg plate worn by the mother, and then that beams the results wirelessly to the display monitor at the bedside. Now, this is a huge win, because by inserting this once, obstetricians get a lactate result every minute instead of having to take a blood sample for a single snapshot. Now, insertion is similar to an existing device, the fetal scalp electrode, which only measures fetal heart rate and is already used in 22% of childbirth already. So obstetricians already know how to insert this device. The wireless design also makes it much easier for mothers to move in labor, which means that midwives support this product. Now, with real-time and continuous access to fetal lactate data, obstetricians around the world believe they can prevent unnecessary C-sections and babies from getting permanent brain damage in childbirth, leading to better patient outcomes and hugely lower cost of care for hospitals and insurers. Now, we've had overwhelming and unanimous support for this device from hundreds of obstetricians, midwives, and mothers now on 6 continents. The FDA has also labeled the device an FDA breakthrough device, and that recognizes its potential to transform a huge problem in medicine, and it's designed to help expedite its entry into the US market. So very exciting for us. Now, obstetricians anticipate they use this in about 50% of all their deliveries, and that creates a huge recurring global market of around $2 billion per year in just a few developed countries, and a further $6 billion if we look at the emerging markets. Now, let's make this more tangible. 3 years after market entry, we expect to make 350,000 sensor sales, driving $150 million in revenue from just Australia and the US. And that's just 6% of our total addressable market in the US. Now, what have we done today? We're really very capital efficient. We've raised $7.7 million in private funding. And on top of that, over $11 million in competitive grants, R&D tax credits, and contributions from project partners. Now, we've used this to build a team of over 30 highly skilled and specialized personnel in biosensors and electronics. We've created the nation's first pilot advanced biosensor manufacturing plant right here in Perth. We've scaled a product from the bench to a clinical prototype in under 3 years. And we've tested this in over 35 gold standard fetal labor studies. We are first movers in the fetal lactate biosensor space with 3 patent families and significant trade secrets. As I mentioned, we're an FDA breakthrough device, and our senior advisors have launched tens of products globally, meaning that commercialization has largely been de-risked. We've got a really exciting 18 months ahead with some huge inflection points, our first in human trials and a first in fetus trial in early 2024. We aim to wrap up clinical trials in 2024, regulatory approval for the TGA and FDA in 25, and market entry in 2026. Currently, we're raising $7 to $8 million with $6 million already filled. And we really look forward to hearing from you as we continue on our journey to build momentum to become a global biosensor leader and transform obstetrics for the globe. Thanks very much.
Thank you, Arjun. Our next presenter is Tom LG, CEO of Recce. Tom?
Hi, everyone. Sorry about that. Just had a
Hello.
computer issues.
No problem.
Let me get my presentation up.
Perfect.
Right. Okay. So my name is Tom Algie. I am the founder and CEO of Recce, and I'm very excited to be here today to present to you to Recce. So Recce exists at the intersection of renewable energy and energy transition, Bitcoin and blockchain technology, as well as this wave of computer processing demand that we all are going to require more and more of. And so what is it that we actually do? We build, own, and operate data centers, and these data centers are extremely responsive to changes in grid requirements. And so we can adjust our power consumption of our data centers up and down to meet changing grid requirements. Now this particular problem, and I'll get to a bit more on this later, is only going to worsen as more renewable energy is built. And so our revenue model is really multiple streams. It's Bitcoin mining, it's high performance computing, such as GPU and CPU processing, as well as energy services and demand response services. Additionally, we're developing proprietary technology, novel technology to deliver even more energy services to the grid, such as helping renewable energies stabilize voltage, frequency stabilization, as well as building a marketplace for what we call non-time critical computing, which really allows us to provide computer services as well as being able to switch our data centers off and on. We've got a substantial growth pipeline across Australia and New Zealand, and very excited with looking towards the future. So really, the investment highlights, we are a technology and infrastructure company. And so we're run as a platform. And so the actual projects that we deliver are subsidiary companies to the overall platform company. We began with Bitcoin mining, but we're developing into other markets such as, general high performance computing. We've got an existing project operating, and actually I'm extremely excited to announce only last night there was an expression of interest to buy our New Zealand operation, and so which came out of the blue, but I had the absolute pleasure of discussing with my board only this morning about what that might look like if we go through with it, how we might even be able to give some cash back to our shareholders, which for a company of barely 12 months old, I think is very exciting. We've got, a strong growth and project pipeline. I've got the next project actually contract on the table, which is a project in South Australia. And, our pipeline is sort of exceeding over $100 million of capital deployment in the next 5 years. As I mentioned, strong business case and revenue model for what we do, and committed and I think very experienced management team. And so onto the problem, just to recap on this. Well, quite perversely, the problem here is actually renewable energy. And it's an extremely exciting time in the energy transition space. For I think the first time in human history, energy is becoming distributed and more remote. For the entirety of our evolution, we have had energy close to where we need it, and that energy has become larger and more concentrated, culminating in the large coal power stations that are right next to city centres. And that whole model is flipping on its head. Energy generation is becoming distributed, and it's becoming remote as we start to deliver wind farms and solar farms and other renewable energy projects remotely. Now that creates a huge problem in how we actually maximize the value of that energy and how we make that energy commercially viable. And only half an hour ago, when I looked at the spot price of electricity here in Australia, a lot of the actual spot prices for electricity were negative. And so therein lies the actual problem with renewable energy, is that it can't by itself match the supply demand. And so the grid and how we manage that needs flexibility. And there are obviously a wave of developments within battery technology and other things like that. But what we're looking to do is control or manage the sort of the flexibility from the demand side. We're putting in data centers, and here we are. We have data centers that are either co-located with renewable energy or located remotely. Those data centers are able to modulate the energy use and to compensate for fluctuating supply and demand. And as I mentioned before, that means that we then are actually tapping into multiple markets with our business model, the frequency and demand response markets that do exist here in Australia, as well as computing markets such as cryptocurrency and also high performance computing.
Please make your closing remarks, Tom.
Yep. As I mentioned, we are a platform company. And so, the investment that we're asking for is in the top level, not necessarily the project finance underneath. Our competitive advantage compared to some of the other data centers and grid scale batteries, we're the only ones that are really getting deep into energy services as well as the data center services. And so I think that really that highlights the difference between us and some of the traditional players in this game. As I mentioned, a very experienced team that we've got. And so therefore, what is the ask? We've already raised 2 million, which has gone into deploying the first project. We're seeking an additional 3 million to expand the business and grow our research and development. And so that's it. And there's a photo of our first project. So thank you.
Thank you very much, Tom. Our next presenter is Yash Verma, founder of Empress Capital.
Hi, everyone. It's a pleasure to be here today. My name is Yash Varma. I'm the founder and general partner at Empress Capital, and it is a real pleasure to be here. I'm just going to share my screen, and I'll just kick things off. So I hope you can all see my screen now. So look, as mentioned, I'm the founder and general partner at Empress Capital, and we really believe in investing in people and innovations that are going to change the world. So Empress Capital is a venture fund that invests in early stage AI companies. And we believe that AI is going to unlock creativity like we've never seen before and really move humanity forward. And we believe this is going to provide some great investment opportunities. So look, we've just launched a 20 million venture fund, and we're really excited to be able to offer wholesale investors and clients here in access to investments that are not often accessible to most people. And I should add that, VC is one of the highest performing asset classes, if not the highest performing. Just thought I'd throw that in there. So look, why are we investing in AI? Now, I'm sure there's been a lot of hype, but our research shows that AI is really going to be the next platform shift. Now, we've seen that with cloud, mobile, and social, and the impact that's had to our lives and businesses, and equally the sort of investment opportunities that come with these big changes. So, AI is going to augment almost everything we do and unleash productivity like we've never seen before. We're only just seeing the very first beginning parts of this, and we're also seeing, this is going to create new business models, and equally the industry itself is going to grow at a significant rate year on year for the next 10 years. So this is going to be as significant as the agricultural revolution and the industrial revolution. And the real driver is AI is now performing better on many accounts than most humans. So we see this as being a big thing. The market size of this is massive, and we really believe it's important that investors can capitalize on this. And we want to give investors this benefit. Many of the things that were never possible before are now becoming possible. But there is lots of hype, and it's our job to really be able to filter through and select those key investments that are going to give that return. So a little bit about why we think this is also going to happen. Exponential technologies like robotics, genomics, and renewables are fueling this, along with the sort of large language models, both open and closed. And we're starting to see this infrastructure being built up, much like was done in the early days of the internet. So it's becoming more mature, and more people are developing in this space. So why we're named Empress Capital after the Empress tree. You can notice our nice purple tree, but it is the fastest growing tree in the world. And we like to think it grows to harvest within 10 years, which is what we like to believe our companies can do. And so we've got a fantastic team. A little bit of background about myself. I have had a technology background for 20 years, had a software development and consultancy based in the UK, in London and Scotland, with clients all over the world. We had hundreds of thousands of corporate users of our software. I grew this business over 20 years, exited this about 5 years ago. And since then, I've become a high performance coach, work with founders and their teams to really drive out, great performance, but equally around aligning, what they do to succeed. I've also been an angel investor, studied AI at Stanford, and that's what's driven me to form Empress Capital. We've got a great team, people like David Baxby, who's worked with Richard Branson and the Wes Farmers Group, Pravat Sethi, who's worked with the Murdoch organization, both on the investment side and otherwise. And so we have a wider team as well who provide great knowledge and help us really filter and select and do the due diligence that we need to do to be able to select those great AI investments. So, we don't just invest in companies, we look at ways that we can add value. And that's in 4 key areas around business development, opening doors for people with our investors, as well as opening those sort of big clients, team building, helping with hiring, mentoring, and coaching, as I mentioned, is one of the big things that I believe in. So we have really done a lot of work around moats, AI moats, and you're going to see a lot of solutions, but really we are interested in what makes a unique AI investment. I'm happy to talk to you further about this if you'd like to. So summary about our fund, it's got a 10-year lifespan. Our target size is 20 million. The investment size for wholesale investors is 50K. Look, this is normally 250K outside of the wholesale investment platform. And we believe that really gives investors an opportunity to have exposure to this unique investment. And, we'd really love to talk to you further if this is of interest and it fits into your overall investment mandate. And look, we've had a lot of interest in what we're doing. We believe now is the time to do this. So look, we'd love to talk to you further. These are some of the investments we've already made, and we can run through, and details of this are available on Crisp. And we'd really, really like to have a chat. Access Crisp, that's what our deal room looks like in Crisp. And I really appreciate the time today. Thanks so much.
Thank you, Yash. We've now heard from 16 companies, and to wrap up our head start, we have a special guest speaker today. He will be speaking on investing in fast-growing private companies, insights for investors. His name is Brendan Lyons, Head of Private Investments. And let me give a bit of an introduction to this keynote. With 6 private funds and 88 private investments over the last 5 years, Perennial's keynote presentation will outline a comprehensive overview of private market investing, including the key trends, ecosystem, and strategies, and why investors should allocate capital to private companies. Over to you, Brendan.
Thank you, Esther. My name is Brendan Lyons, and very glad to be here presenting today. I'll share a presentation with you, which we can run through over the next sort of 10 minutes or so. It's about 10 or 15 slides. Hopefully everybody can see that. Firstly, I'll just start with a couple of thoughts on Perennial in particular and give people some background on our business. Perennial's an investment manager based in Sydney that's been operating for more than 20 years now, with about $8 billion total assets under management across a number of different strategies. The part of the business I'll be talking about today, or that's most relevant to private markets, is Perennial Private Investments, which I head that business. We have around 6 funds that invest privately and over $700 million invested. In the 5 years we've been doing this, as Esther mentioned, we've made around 88 different investments, and around 30 of those have already reached IPO or private sell down or takeover, and we're the largest player in Australia in this sector of the market. We have a team of 5 experienced professionals that work on our private portfolio, and a team of 11 that work in the small cap and mid cap listed area that we sit alongside and can also be a key part of our process. We have a important mix of skills here. Across an experienced team, we have experience both in private markets, public markets, and transactional experience, be it IPO advisory or corporate advisory experience, to help companies that are looking to transition from both private into public markets. I've talked a little bit about the history of Perennial, and this just shows some of the evolution of our funds and how we've invested in the private space. Our business is 100% owned by staff and operated by the Perennial staff and the investment professionals. We are continuously looking for new investments opportunities for investors, and that's led to us to evolve our business over time from large caps to small caps to private. We have a fund that's open at the moment that's focused on private growth investments. So I'll move on to some of the key trends that we're seeing in private markets and the IPO market, which might be interested to wholesale investors. 2022 was very much a reset year, I think, for the market, both privately and publicly. We saw what happened with the sell-off in global equity markets. We saw a similar reset going on in private markets with perhaps a 3 or 6 month delay. We think that was obviously overall a positive development. Obviously some difficult period for some investors, but from the froth we saw in 2021 and obviously very low interest rates and very high liquidity led to, I think, high valuations and somewhat loose terms in that period. And what we've seen at return now is much better valuation and much better structure and terms for private transactions. We think that's positive for the companies and for investors. The pipeline remains very, very strong. Companies do continue to say they want to stay private for longer rather than list or sell early. They can find an institutional investor like Perennial or others that can enable them to stay private, get a lot bigger, and make the business more predictable. Then they will pursue that rather than rushing too quickly to an exit or an IPO. In terms of how the valuation reset that we've seen, this chart shows a sample. It's one way in which to measure it. It's the revenue multiple, forward revenue multiple for Australian and US listed technology companies, and you can see how from the sort of very high levels we saw during the COVID period when liquidity, interest rates was high and interest rates were very low. We've seen obviously a marked reset down back to levels we perhaps haven't seen for 8 or 10 years in terms of this metric. One of the other key thematics we've seen emerge over the last 12 months is just the importance of cash flow. Clearly, businesses which have high cash burn in a higher interest rate environment are going to be discounted more heavily, and the market and investors are going to favour companies which have a cash positive or at least cash neutral. And what this chart here shows is the listed companies in Australia as those in the light blue are the cash generative companies. You can see that they've over the last 12 months outperformed in share price terms as compared to the dark blue here, which are the cash burners which have underperformed. Another recent feature of the private market and in some parts of the public market, particularly within US technology companies, has been reductions in costs through reductions in staff, which are in the case of tech businesses make up a large portion of your cost base. Companies are doing this clearly if they are cash burners to extend their runway and also enable businesses to focus on their core business. And some examples here are listed which have been made public in the last 3 to 6 months. Just to chat a little bit about the IPO market and what we've seen over the last 12 months and arguably the last sort of 3 years since the outbreak of COVID, as the IPO market has been difficult. There's been periods where it's been strong, periods like the last 12 months where it's been much tougher. In terms of the number of IPOs in calendar 2022, you can see it's about in line with the average. We list around 100 companies in Australia, plus or minus 20 or so businesses every year. But in terms of the dollars raised or the size of those IPOs, it's been very small. In fact, it's been the smallest, I think, in almost 30 years is what we've seen last year. So what that means, there was a large number of very small IPOs, most of them in the mining exploration area. Now, in terms of what helps make a good IPO, there's many things you have to get right in order to be successful. And then, as I mentioned, the last 3 years, many of the larger IPOs have been unsuccessful and traded below issue price because they haven't perhaps ticked the 6 main boxes I've highlighted on this slide. We are starting to see a bit better activity. We're in the middle of February reporting season for listed companies now, and the market's focused on that. But as we get into March, I think you'll start to see a few more IPOs test the market. And typically what we see in a cycle is the earlier IPOs tend to be the highest quality ones. And as we get late in the cycle, perhaps some of the lower quality businesses start to list. So we're waiting for to see what's around the corner. But in terms of what's important, it really is at very high level, and this is how we would assess an IPO, are they ticking these boxes? Does it have the right management team? Is it the right industry thematic to be listing? And does it have the right financial profile? And that goes to the balance sheet, cash flow, and profit and loss statement. Are the right counterparties? That's the advisors, brokers, and the other counterparties, shareholders. Are they the right people around the business? You need to be able to market the story and find the right investors who are interested in that business, whether they're here or offshore. And the right structure is absolutely critical. And that goes to the pricing of the IPO, the selling of it, and the type of securities in which it's offered. So I'll turn to talking about how we invest in private businesses, and there might be some insights here for in a broader sense. The private markets universe is very, very large, is the first point to make. There's a bit over 2,000 companies listed on the ASX. There's about 80,000 companies registered in Australia which have revenue more than 5 million, and half of those have revenue more than 10 million. So it's a huge universe. So the private market's much larger than the public market. And this excludes, obviously, the other couple of million companies which are less than 5 million in revenue, some of which are fast-growing companies and will move up into these higher categories over time. And the type of investors that we see across the spectrum is illustrated on this graphic. The pink line at the top showing the corporate life cycle from left to right, and the sort of investors that investing at certain stages. We have a lot of people, a lot of funds and individuals that they're happy to invest at the startup or seed stage. And in fact, there's over 150 registered venture capital funds on the government website at the moment. So new ideas and startups are getting funded in Australia. We think that's a good thing. But when we see, once you get beyond that early stage, there are less and less investors who are specialised in the private growth stage and also the pre-IPO stage of businesses. And then once you get to obviously if a company goes to being an ASX listing or public listing, then there's once again a very large number, hundreds of equity funds which can invest in listed equities. In terms of where Perennial play, we don't invest in startups. We invest in companies which are established and looking to grow an IPO and go on to be listed companies. There is a bit of a flywheel effect that we've seen have developed in Australia in the last 5 to 10 years, which is worth mentioning. As I mentioned, there's a large number of startup funds which have raised money and deployed that in recent times. That means that while not all businesses are successful from that early stage, it means there is a lot of funding that comes into that part of the market, and the best ideas do come through. That leads to obviously investments in more and more companies than would have been the case 5 or 10 years ago in Australia. And the people involved with those companies, whether it's the founders, it could be the executives, it could be the employees or the board of directors, creates people with more experience having building businesses and taking them through to IPO or exit. And so and then what we're seeing now is some second and third generation founders in Australia spin out of existing and successful businesses. Some of them because they've sold them, some of them because they've become public companies and they've decided to go back and start a new business again. And I think that sort of ecosystem is something that's developed, particularly in the US, and we're starting to see that sort of flywheel effect also occur in Australia. And so how might you filter a private company investment? And these are some of the high level metrics that we look at Perennial. That's perhaps not dissimilar to the IPO list I mentioned earlier, but slightly different to tailor for private investments. We do want a founder. We are investing in founder-led businesses and looking for businesses where there's strong alignment, and that's normally coming through the same sort of equity holding as we have. People are incentivized to grow the value of the company in that way. We are investing in businesses where there's already product market fit, and what that means is they've already achieved a certain level of revenue. I mentioned we're not investing in startups, and when startups is inherently risky, and we know not all businesses make it. By the time the business gets to 5, 10 or 20 million in revenue, it's normally got an established product and established customer. It is easier to do due diligence and value that business, and has got a greater chance of success, either as it goes on to be a public company or it's going to be more attractive as an M&A target to larger businesses. And we are looking for fast-growing businesses. Businesses can grow quickly, can get to a scale where you've got a number of different options. Obviously, a lot of smaller businesses in Australia are small and happy to stay that way. But they're not ones that are likely to attract institutional investors like us or others. Leading unit economics goes to just the investment case and how the metrics around the business operate. So it's what are the returns that business is making, what are the margins that it's making, what's its ability to get operating leverage on its cost base, so that once again, as the business grows, it starts to become more profitable. Competitive advantage and unique IP is important. What is the moat around the business? Can it survive and compete and have some competitive edge, which not only makes it successful in Australia, but potentially globally, and doesn't have a large market in which it can grow into. And valuation is critical. Buying these assets at the right value is important. It's part of our discipline. We don't tend to chase those high value, sort of perhaps more the banner transactions that sometimes get reported, because if you buy a company at the right valuation, in the case of private businesses, it should be a substantial discount to public businesses and adjusted for the illiquidity and the size of the business, then you've got a better chance of making strong returns for your unit holders. So what are founders looking for in terms of a partner? It's much more than just providing capital. They are looking for guidance and help as they grow their business and look to professionalize it. It may be anything from the sounding board, and we take board observation rights in most of our companies, for example. They're looking for that sort of input from us. It could be introductions to counterparties, to customers, to other investors. They are looking for someone that can grow with the company, who not just invests once, but able to invest all the way through. In our case, we can invest from private growth through to pre-IPO to IPO and continue to hold as a listed company, which is quite a differentiator, perhaps to other private strategies. Providing sort of financial guidance, and it might be around the capital structure, it might be around the corporate strategy and M&A transaction the company's looking to do is another area they're looking for advice from. Sharing best-in-class practices, might be anything from ESG to board composition through to sort of cost base and other financial metrics is something that you can provide when you've done a lot of different investments in other companies and can provide those insights. And then that ability to get the business through to an IPO or an M&A exit, And that experience is another thing that they're looking for from their institutional investor. A diversified portfolio, I think, is important. Don't have all your eggs in one basket. This chart here shows the example of the sort of sectors that our 88 investments have gone into over the last 5 years. You can see it's a broad spectrum of the Australian economy. I sometimes think of it as the growth areas of the Australian economy, these sectors. So we don't invest in any cyclical businesses. Cyclical businesses who are driven by commodity prices can be, or some sort of macroeconomic cycle means that sometimes the cycle determines the return or the outcome rather than the growth of the business. So we avoid that sector. We are looking to be diversified by industry sector, by geography, by security type, whether you're investing as equity or convertible notes or some other instrument, and also looking to have investments which mature at different stages, in which case you're not all investments are looking to IPO or come to market at the same time. So just to summarize, why now? Is this a good time to be investing in private business? We think it certainly is. The pipeline is enormous. There's a lot of early stage funding that's going on. We're meeting with hundreds, if not thousands, of companies every year and investing in a small number of those. We think that companies do want to stay private for longer, get a lot bigger, take on an institutional investor, and then make their business more predictable and successful when it does get through to either an IPO or a trade sale. And with the equity market sell-off and the readjustment we've seen in private markets over the last 12 months, valuations and terms have become much more attractive. We've also seen a reduction in competition in this part of the market. A lot of the offshore private growth funds, whether they came from North America, Asia, or Europe, have retreated back to their home markets. And so as a result, there's a lot less providers of capital in the market today, which enables just to place in the hands of those domestic providers of this sort of capital. Thank you for listening.
Thank you very much, Brendan. So today we've heard from 16 companies across a range of company types, ranging from private companies to ASX-listed companies, properties, and funds. These are going to be the different streams of our Emergence Live conference in Sydney on the 23rd to the 24th of March, in just a little over 5 weeks from now. So if you would like to hear more, please go to register for our Emergence Live conference in Sydney. And there you'll be able to hear a longer version of the presentations that you've heard today. Also meet the presenters live at their exhibition areas, as well as see other companies as well. We are expecting about 100 companies, as well as hundreds and thousands of investors in the room. In addition, this year we are scaling Emergence worldwide and organizing Emergence Global, which is a series of online events culminating in our live conferences in Sydney and London. Emergence Global will connect the global investment ecosystem of VCs, funds, family offices, angel investors, founders, execs, and operators, enabling you to expand your network and develop investment, strategic, and commercial opportunities within a limited 2-month season of events and on-demand networking using our proprietary CRISP conference software. So thank you so much again, everyone, for attending today. Please feel free to connect with the presenting companies on CRISP, as well as register for our upcoming Emergence Global and Emergence Sydney conference. Thank you also, a special thank you to our guest speaker, Brendan from Perennial Partners, and also to our presenting companies. Thank you very much. Bye.